Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. 2025 is off and running with trading underway in the Asia Pacific after Wall Street's first session of the new year. It is a market holiday in Japan. In a moment, we'll be speaking with Jay Hatfield, CEO and CIO at Infrastructure Capital Management. But first, we're following developments in South Korea. At this hour, anti-corruption investigators are seeking to arrest impeached President Yoon Suk-yeol at his residence in Seoul. Now, Yonhap News is reporting officials are attempting to exercise a warrant for Yoon. His lawyers call the warrant, quote, invalid. Yonhap also reports that a South Korean military unit prevented those officials from entering the building. Stay with the Bloomberg platforms for the latest developments in South Korea. We turn our focus back to markets. Joining us now is Eva Lee. She is head of Greater China Equities at UBS Global Wealth Management. Eva joins us from our studios in Hong Kong. Good morning to you and Happy New Year. I'm glad you could make time to chat with us. You and I were talking a moment ago about how busy the fourth quarter was, especially the month of December for your business. What was the reason for that, do you think?
Well, I guess, Trump being elected, everyone expects a lot of changes to happen after he assumed the president's office, which is the third week of Jan.
Yeah.
So, in fact, our, CIO, UBS CIO had revised down the expectation in terms of interest rate cuts to 50 bips for 2025. Obviously, we already had the December rate cut as expected, but originally we were at 100 basis point cut. Now we reduced to 50 basis points. So that will have a big impact across the board, which is like the US dollar, the expectation in terms of strengthening or weakening, and also the other currency, how much of a rate cut, particularly in Asia, how much of rate cuts that they will have as a result. So all these would impact, of course, they will impact gold and, all the bond yield and everything. So that's why we want to have our client prepare, have the portfolio positioned accordingly.
So you're in Hong Kong. What are you hearing about the economic situation on the mainland right now? Is the consumer still lacking in confidence to such a degree that domestic demand will kind of remain in a slump? Or are there signs of maybe things turning just a bit more positively?
The December number is definitely better than expected. But if you dissect, sort of break it down, what really driving the growth was the manufacturing activities. The export side seems to be better. But having said that, people would sort of saying, oh, yeah, because they want to get all the export done before Trump put in the tariff.
Right.
But on the other hand, the property sales seems to be better in December, but that was mainly in Tier 1 city. Low-tier cities remains weak. So back to your questions, consumption sentiment remains weak. I think structurally, we have these property, sales overall is still not yet, sort of full recover or reviving. And then on the other hand, the local government bond seems to be, they already have a solutions how to resolve that. But still, the overall, in terms of employment, the prospects people feeling is not as promising as, a few years back. So consumption as a result still weak. Like, of course, the auto sales were strong. The home appliance was strong. That was because of subsidies. But apart from that, it's still weak.
So what are you advising clients to do then in an environment like this, particularly for clients in Asia? Are you directing them away from the region and into places like the U.S.?
Diversification definitely would be crucial. Our, as allocation positioning for China is neutral. For U.S., it's recorded attractive. So you more or less, can imagine, with the sort of positioning that we recommend. I mean, the fact is we know that China valuation is cheap, attractive or undemanding, how you put it. But the tariff risks, it's definitely ahead. Now it's not about whether tariff will whether we will have a tariff hike or not. It's how much that will be. So I think that's why this sort of derating, multiple derating risk is still there, or the pressure is still there. But on the other hand, in the U.S. side, the corporate earnings has been better than expected. The investments in AI continue. We have two themes: AI, power resources. These are the two, sort of big theme that will continue to drive growth in U.S. market. S&P target we set at 6,600 by the end of next year. So this year. So all these making us recommend investors diversify not just in equities, but equities, bonds. But on the equity side, we favor U.S.
What about the technology story in China? Are there signs that it's beginning to develop in such a way, maybe because of the restrictions that have been coming from the United States, those export controls on things like advanced semiconductor technology? Are you seeing the beginnings of another leg up maybe for technology in China?
Well, I mean, the technology in China, you name it, it's like the e-commerce, the gaming portal. These stocks actually have been under pressure due to the fact that they are proxy of China. So these stocks get short, particularly from overseas investors, when there are, worry and concerns about the macro. On the chip side, like you're talking about semiconductor and all that. Yes, I mean, if U.S. is going to impose any restrictions in terms of advanced, chip that would affect China, or they broaden, the export restrictions onto this sort of chip exports, we're going to affect China. But I think that's already somehow expected by the market.
And the diversification of supply chains away from the mainland to countries maybe like Indonesia or Vietnam or even India. I mean, is this something that's going to be a continued theme in 2025?
We've got to be very careful. It depends on how Trump is going to impose all these, tariff impact, because he has been saying, say 60% tariff on on China, but 10% on the rest of the world. If this is the 10% of the rest of the world, I don't think the market have fully priced it in, and that would definitely affect the, the places that you mentioned, because Vietnam, Indonesia, particularly Vietnam, if you compare to 2018. Until now, there is actually a significant increase in terms of export to U.S. While at the same time, they, if you look at the data, they also have imported a lot of raw materials from China. So you can look at it, it's like a quasi, China manufacturing platform. So if U.S., sort of look at this data and sort of target Vietnam will be affected, or some other regions that have been, receiving this diversifications of manufacturing platforms from China will also be affected.
So, Eva, I'm curious. You seem to be questioning a lot. There's a lot of uncertainty. I get that. I'm curious about how much cash you're sitting on right now, waiting for opportunities, maybe for the dust to settle and reveal some things that may look attractive to you. Are you holding a fair amount of cash these days, or is most of the money that people have given you to put to work already been allocated?
Our theme within CIO is always stay invested. It's very difficult to time the market. So how we do it, it's we diversified across equity, bonds, and private. So alternative investment is a big thing. So we can rely on, some of these very professional hedge fund managers, private equities, private debt managers. They're not being affected that much by the up and down or volatility in the market. And in fact, on the other hand, they're able to invest while people sort of stay put. So and plus they can react very quickly. So this is a theme that we actually have been pushing even before COVID. And in fact, it worked really well, particularly in the downtime, let's say 2021, 22. So that's the way we go pursue, in particular in these sort of volatile moments.
Eva, I know that you're head of Greater China Equities for UBS Global Wealth Management, but if you can, give me a little bit of your perspective on the political instability that's happening right now in South Korea. I was struck today by the fact that the equity market is rallying in the face of the fact that we are being told that the impeached President Yoon Suk-yeol is facing arrest. Hard to maybe understand the two as they are juxtaposed, but I'm wondering, broadly speaking, when you look at the South Korean market, what do you take away?
In fact, if you look at fundamental, people always sort of look at the tech side, which is the Taiwan and Korea markets. And in fact, there were clear divergence, like Taiwan market obviously have outperformed Korea market by large, and that was relating to the chip side, which I cannot mention company, but you know which one I'm talking about. And as a result, the divergence is actually because of that particular company in Taiwan. It's able really to ride on that AI chip, very advanced chip technology, while Korea company seems to be sort of lag behind. So this fundamental actually explained the divergence and also potentially the continual of one market outperforming the other. This regardless of, sort of the political situation or the valuation. I think that is something we should focus on rather than, obviously the political side would affect, there is another element of it. But I think since this, what happened in Mauritius law, the curfew or whatever, that people already expect some changes of political instability in Korea market.
We'll leave it there. Eva, it's always a pleasure. Thank you for visiting with us, and Happy New Year to you. All the best for 2025. Eva Lee is head of Greater China Equities at UBS Global Wealth Management, joining us here on the Bloomberg Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Joining us now is Jay Hatfield. He is the CEO and CIO at Infrastructure Capital Management. Jay joins us from here in New York City. Jay, thanks for being with us. Happy New Year to you. What did you make of today's price action on the first day of trading in the States?
Happy New Year, Doug. What we thought actually was happening last week was just a normal rebalance. So big pension funds buying bonds and selling stocks. So we had, actually that was going to reverse earlier in the morning before Tesla announced their shortfall in deliveries. And that really caused the futures to drop and destabilize the NASDAQ. So we had a pretty big drop for a while. But we think that as soon as we get into earnings season next week, then the market will start rallying and stabilize. Whenever you don't have earnings, you get a lot of volatility around very little information.
One of the other things I think that the market's been struggling with is the notion of far fewer rate cuts from the Fed in the new year. And I was struck by that GDP forecast, the Atlanta Fed's GDP Now model estimating real growth at 2.6. Yes, that's down from 3.1 from last week. But am I wrong here? 2.6 is still pretty healthy.
It absolutely is. We do think, though, that that direction is going to continue. What the Fed is missing is their hawkish rhetoric has caused really the only important financial condition to blow out. So we had a 90 basis points increase in the 10-year. We're already in a housing recession. We think that's going to worsen. So we think that unless rates drop, we're going to have only growth of 1% to 2% in the first half of this year. And then the Fed will relent. And we actually think there'll be 4 cuts this year. Wow. And the 10-year will end below 4.
So how are you setting yourself up for 2025 then, given everything that you just kind of sketched out there?
So we have a 7,000 target, but that is contingent on rates dropping and a 18% corporate tax rate. We do think that at least on a risk-adjusted basis, that yield and value stocks will outperform. Particularly, our number one call is investment banks. The large caps are Goldman Sachs, Morgan Stanley. Those are some of the biggest holdings in our ICAP fund. But we think there's going to be 2 more legs to the stool this year. An M&A boom because of deregulation on the antitrust side. But also we think there's going to be, particularly in the second half, a AI IPO boom that we haven't seen yet. So we're forecasting 30% above consensus estimates for Goldman Sachs, for instance. So we're super bulled up on the investment banks.
If you look at what happened since early 2023, so for all of 23 and 24, I think the S&P 500 was up by more than 50%. Do you have some projection as to what we may see from the S&P in 2025?
Absolutely. So we have a 7,000 target, which is roughly a 16% return. The normal return is 10%. So if we don't get that corporate tax reduction, so we use the terminal to get consensus 26 earnings, because of course, if you have a year-end 25 target, use 26 estimates, but that number is only 305. So to get to 7,000, we're adjusting that up, to correct for the fact that corporate taxes are lower. So it's about a 320 estimate. So that's the math. We do think we can hold this multiple that's quite high if we get lower rates and if we get a continued AI boom. So we think 7,000 is the most reasonable target right now.
So if you're thinking there are possibly 4 rate cuts from the Fed in the year ahead, I'm going to imagine that there are a few screaming buys in the bond market. Am I wrong about that?
Well, we do think that we favor, our biggest fund is PFFA. It's like 2/3 of our assets. That's a preferred stock fund. We think the riskier portion of fixed income will do really well, because that's where you want to be when rates are dropping or at least stable and the stock market's strong. You want to have spread product that typically tightens when the stock market is rallying. So we think that preferred stock and high yield bonds, which are pretty similar asset classes, will both outperform other asset classes within fixed income.
You were talking a moment ago about the fact that maybe there are opportunities in financials, and I'm wondering about kind of the real estate situation, particularly commercial. We've talked in the past about how the office complex is still in dire straits. Is this an area of concern for you still, or are you not in an environment where you expect rates to fall? Do you think some of that risk will be a little bit mitigated by those falling rates?
Well, we've had a non-consensus call, which has been correct for 24, that the office freakout was overdone. Not to say that for B and C offices, that's a huge problem, but keep in mind most of the REITs that are publicly traded have A buildings, similar to most of the buildings in Midtown Manhattan, like Bloomberg headquarters or where we're headquartered. So we've been correct about that part of it. The reason I didn't highlight that as our number one call is that I do believe that it's now dependent on rates going lower to really good returns. So that's probably our most controversial call, is that rates are going to go down. Investment banks will do fine. Other banks might not if rates are higher. REITs won't do that well. Small caps won't do that well. So our call that non-tech will at least keep up with the tech sector is dependent on lower rates.
Okay, so declining rates, then I'm thinking immediately weaker dollar, and then I'm looking to markets offshore, and particularly those in Asia, and I'm thinking, okay, valuations that are relatively low compared to the U.S. If the dollar were to weaken, I want to be a buyer of risk assets in Asia, do I not?
Well, there's no question that rates and the dollar are linked, so that's why we don't think we can stay where we are at this 450 level with a 9% appreciation, because it's hugely deflationary in the U.S. It's inflationary overseas. We still think the U.S. is the best place to be. No one else has the technology that we have. I mean, we're bullish on Broadcom. We're bullish on Amazon. And you really can't find those companies in the rest of the world. So we wouldn't buy any one market. If there's an idea there, we don't cover a lot of international stocks, but if there's an idea there, fine. But I think it's best to be in the U.S., participate in, the most capitalist country, one of the most capitalist countries in the world, with definitely the best technology.
Are you generally optimistic about the policies that the incoming Trump administration is going to deliver?
Well, we actually have the polar opposite view of consensus. Specifically, we think that tariffs, we're not a huge fan of tariffs, but if they do happen, they're actually deflationary, because it's just a one-time increase, and then it reduces demand because it's like a sales tax, and you can use those proceeds to cut corporate taxes. So we have the opposite view of consensus on that. We also believe that if you really listen to what the Trump administration is proposing, they're proposing to deport criminals, and there's some discussion of expanding H-1B visas. So those two combined would be very deflationary, because you get college-educated immigrants coming in and producing more GDP. So we think that most of the concerns about the Trump policies are political talking points left over from the election.
Jay, we'll leave it there. Always a pleasure to have a chance to visit with you. All the best for the new year, by the way. Jay Hatfield there. He is the CEO, CIO also at Infrastructure Capital Management, joining us from Midtown here in New York City on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.